Okay, we're back with more on risk and return, and this is the second part of the lecture on risk and return. Um, and what we will do in the last one, talked about, um, we ended the last lecture with diversification and uh, the difference between systematic and unsystematic risk. And here we're going to um, basically try to measure a systematic risk, right? And the measure of systematic risk is called beta. So here are the returns over the last 5 years for whatchamacallit stock and um, the P&Q 500 market index, right? A market index like the S&P 500 is basically a portfolio of 500 stocks. And that gives us, if we saw, when we saw last time that with even with a 40 stock portfolio, you get pretty well diversified uh, portfolio. If we have a portfolio of 500 stocks that come from different sectors in the economy for different companies, then we can pretty much assume that it's completely diversified portfolio. In other words, it does not have any diversifiable risk left in it. It's all systematic risk. Right? And so by comparing returns of a particular stock, or in this case, it's the whatchamacallit mutual fund, to the returns on the market index, we actually are able to extract um, a measure called beta, which measures the systematic risk, right? So by definition, the market index will have a beta coefficient of 1. And then um, anything greater than that is greater risk. Of course, less than that, it's less risk. But here we have 5 years of whatchamacallit mutual fund index returns and the market index returns. Um, and we need to calculate beta, right? So a beta is actually defined as the covariance of the stock, or in this case, it was the whatchamacallit mutual fund, but it's the covariance between the return of the stock or the asset and return the market portfolio divided by the variance of the market portfolio, right? That's the official definition of, um, of the beta. And basically, um, here are the formulas. How you calculate covariance is take the deviation uh, of one thing from its average, right? And the deviation of market portfolio from its average and multiply them and then add those up. As a matter of fact, it's very similar to variance calculation where we actually take the deviation and multiply it with itself, so we're squaring it. Here we're multiplying two deviations, right? And then you are going to take its average by dividing by n minus 1 for a sample, or divide by n for 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 if it's not a sample, if it's a population, just divide by n, right? But um, you do that, but that's common. Divided by n minus 1 for a sample in the numerator, divide by n minus 1 in the denominator. So basically, they both cancel each other out, so we don't need to write it. Um, and that's the by definition, that's the beta. And because the standard deviation is actually, um, I mean, sorry, the variance divided by, the covariance divided by two standard deviations, right? So if you took this covariance between I and M and divided it by standard deviation of I and multiplied with standard deviation of M, we would get the correlation coefficient, which is bound between +1 and -1, right? Uh, but due to that, we can also say the variance is correlation times the product of the two standard deviation. Anyways, but those are the formulas. In practice, an estimate of beta can be computed as slope of a regression line plotting a historical series of stocks return as a dependent variable on the y-axis and the market index return as an independent variable. So we got to make sure that when we are plotting, we put the market index returns on x-axis and then the stocks return on the y-axis, and plot when we get the plot of multiple points, and we basically want to draw a best fitting line across that plot, and the slope of that line is the beta, and that such a line is called a characteristic line. And you get some, the figure 6-8 in your book shows you some examples of characteristic lines, or an example of a characteristic line, right? But what we're doing is calculating the slope, and we're using our calculator to get that answer. And here's how it is done. And once again, we're going to be using the data mode in the calculator, right? But now we have two sets of data. So we'll put something for x and something for y, right? So let's do second and 7 to get back to data mode. We got the data from the last problem, but I'm going to clear it with second C/C. And now we have to be careful that we put the market index returns in the x values, and the mutual fund index return should mutual fund return should be y, right? So let's go. So these -5, -6, 13, 21, 22, those should be x values. And then -9, -5, 15, 21, 24, those should be y values, right? So market index return should be inputted as x. All right, so for x1 is -5, so 5 plus minus, enter. Y1 is -9, 9 plus minus, enter. Then x2 is -6, 6 plus minus, enter. And y2 is -5, so 5 plus minus, enter. Then x3 is 13, 13, enter. And y3 is 15, so 15, enter. Arrow down. X4 is 21, enter. Arrow down. Y4 is also 21, enter. Then x5 is 22, enter. And y5 is 24, so enter that. Okay, so now we got all the x's and y's that are entered, and you can use the up arrow key to make sure all the numbers are input correctly, right? And now we go to data, second and 8. We go to stat, second and 8. This time it wasn't just a one variable calculation. What we actually did was linear regression. So we're looking for LIN on the screen. So do second enter, that's the set key, right? Until you see LIN on the screen. And it's actually right after 1B. So once we have LIN on the screen, now we can use the arrow keys to find answers, right? So yeah, there's 5 sets of numbers. X bar average is 9 for X, values, standard deviation of X, population standard deviation of X, average of Y, standard deviation of Y, population standard deviation of y, then we start getting regression coefficients. So we're looking at a straight line whose intercept is at minus 0.7, but that's not important right now. What we're after is this b, which is the slope of the line, and that's the beta that we're looking for. So beta of whatchamacallit mutual fund is 1.1, right? And so that's how you can calculate the beta using your calculator. So what is beta? Beta actually is a measure of systematic risk. Right? If you're considering investing in the following two stocks, we got two stocks. One's called eGullable and the other is EWise. They both have the same expected return. So which one to invest in, if we were going to pick one, that decision is actually going to be based on the measure of risk. If we look at standard deviation, the two stocks have, well, standard deviation of EWise is higher, right? And so eGullable standard deviation is lower. If we were to calculate, say, coefficient of variation, we will get 1, right? 20 by 20 for eGullable, and 25 by 20 is like 1.25, right? 1.25. So we'll go with the low coefficient of variation if we were just looking at investing in one stock, right? But typically, people don't hold just one stock portfolios, in which case beta becomes a relevant measure of risk. And we see that EWise has lower beta, right? So that would be a better investment. So the question is, which of the above stocks would you choose if you're holding it as part of a diversified portfolio? Well, in that case, we should go with the beta. If you're holding a stock by itself, that's your only investment, then you are exposed to the total risk, which is measured by standard deviation. Then you should go with eGullable, right? So what's the difference? Standard deviation measures total risk, beta measures systematic risk, right? And in diversified portfolios, total risk do not matter as much as systematic risk. What would be the expected return on and beta of a portfolio that has 2,000 in eGullable and 3,000 in EWise? So we can calculate expected return and standard deviation. I'm sorry, not standard deviation, but rather beta. And it'll be good news to know that the beta of portfolio is computed the same way as the expected return of a portfolio. It's a proportion weighted average. And the 2,000 and 3,000 will give us the proportion, right? Total investment of 5,000, 2,000 is 40%, and 3,000 is 60% of that. So since both stocks have the same return, we should look for one with smaller risk. If we were to choose one to be part of the diversified portfolio, then we should pick the one with the lowest systematic risk, which is measured by beta. So we want to pick one with the lowest beta. So our choice should be EWise. However, if we were investing all our wealth in one stock, then we are exposed to the total risk of that stock, which is measured by its standard deviation. So we should pick the one with the smaller standard deviation, and that is eGullable. So both the portfolio return and the portfolio beta as proportionally weighted averages of component assets, right? And so for the return of the portfolio, well, each of the stocks had 20% return. So no matter what proportions we use, the answer we'll get is 20%, right? The portfolio also has a 20% return. But the beta of the portfolio will be somewhere in between the two, right? So beta of the first one is 2, the second one is 1.5. Proportion weighted average, 0.4 times 2 plus 0.6 times 1.5 gives us 1.7, and that will be the beta of a portfolio in which we had 2,000 invested in one and 3,000 in the other, right? So that's how we got these proportions from. Total investment 5,000, right? Investment 1, 2,000 divided by the total 5,000 gives us 0.4. Investment 2, 3,000 divided by 5,000 gives us 0.6. And we use those proportions to weight the beta to get the beta of the portfolio, which is exactly what we would do to get the expected return on the portfolio. Okay, so good. So we're going to be talking now about something called the capital asset pricing model. And what it says is that given that it's essentially free to diversify your portfolio, developed financial markets, they do not provide you with a return based on total risk, but only on systematic risk, right? And that's the capital asset pricing model. So let's look at this example. Silver Bullets Incorporated had a product that's used to fight certain unearthly elements of society. Since evildoers come in cycles, the company has highly variable earnings and has a high beta of 4. Right? Now, if you remember, the market portfolio has a beta of 1. As a matter of fact, since the market portfolio is comprised of all assets, we can say that the average beta across all assets is 1. So a beta of 4 is 4 times that. So it's a pretty risky company, right? If the 1-year T-bill rate is 5% and the market index return over the next year is expected to be 12%, what will be the expected return on Silver Bullet stock? If you can buy this stock for $100 a share and have reasons to believe that you will receive $8 per share in dividends and be able to sell for $122, is this stock a good buy? Explain. Right. So first, we will calculate the CAPM model that's explained in the book. We'll be able to allow us to calculate what the expected return will be for the stock, or what should be for the stock. But given these cash flows, what is the return over the next year, right? You're going to get $8 in dividends. You sell the stock for 122. So 122 plus 8 is 130. And if you buy the stock today, you're paying 100 for it, right? Pay 100, you get back 130. That means, given these cash flows, you think that the return is going to be $30. Is that good enough? Actually, $30 on 100, or 30%. Is that good enough? Well, the capital asset pricing model actually tells us the relationship between the stock's beta and its expected return given the market risk, the return on the market portfolio, right, and the risk-free rate. So the risk-free rate is what you get on an asset without taking any risk, like the treasury bills. And the capital asset pricing model simply says that there's a linear relationship. This is actually a straight line equation. The equation for a straight line says y equals mx plus b, if you remember that. M was the slope of the equation, so m is going to be this ERM minus CRF. Basically, it's the slope of rise over run. And this is what, if the market portfolio has the market portfolio has a beta of 1, and that's the premium it provides over the risk-free rate, right? And so this is basically the rise, divided by the run, which is the beta of the market portfolio, which is just 1. That is actually the slope. So that's the m part in the y equals mx plus b, right? B is this intercept part, which is the risk-free rate. And x is the beta, and y, of course, is the expected return. So there's a linear relationship between expected return, the beta of an asset, right? So that's the asset's required return. That's the risk-free rate. That's the expected market return. That's the asset's beta. That's the market risk premium. Anything you can get above and beyond the risk-free rate is the market risk, is the risk premium, right? And the market portfolio provides that return, which is that much above the risk-free rate. So when we subtract the risk-free rate from that, we get the risk premium for the market portfolio. And that's called the market risk premium, right? But if we multiply it with the beta of a stock, then that becomes the stock's risk premium. And so the stock's return is the risk-free rate plus the stock's risk premium, right? Call it the asset's risk premium. So for silver bullet stock, we were given these values, right? Risk-free rate is 5%. Market return on the market portfolio is 12%. Minus the risk-free rate, that's the market risk premium. So 7% would be the market risk premium multiplied with beta of 4. So basically, you get 7% risk premium for a beta of 1, right? Market portfolio has a beta of 1. Multiplied with 4 because this asset has a beta of 4. And so 7 times 4 is 28, right? That's the risk premium on silver bullet stock. Well, that's the risk premium. If you add the risk-free rate to it, 5%, you get the return on silver bullet stock. The return, according to this capital asset pricing model, the return should be 33%. But with the cash flow expectations, we know that we can sell it for $122, get $8 in dividends, so we have a total of $130 over the year. And we pay $100 for it today, we're going to get 30% return, right? So 122, the selling price minus the purchase price, that is basically the capital gains. Then $8 in dividends is income from this investment over the year. All of that adds up to 30% return on the initial investment. Well, we just found out that the stock should return 33% according to the capital asset pricing model. According to theory, given its level of beta, it should, right? So since the required return of the stock is 33%, it has lower return expectation of only 30%, right? So no, it's not a good buy, right? So the CAPM model gives us an answer which we call the required return. That's required by the market given the level of beta for the stock, right? And that's not being met with our cash flow expectations. So how can this get closer to 30%? Well, if we didn't have to pay 100, if we paid less than 100, suppose we paid 95, then we'll have larger capital gains, right? And smaller base, and we will have higher return. So basically, the stock's price at 100, it's too pricey. That stock is too pricey. It should be less than 100, so that we get in the end 33% return. And so here is the graph that charts it, and what we're saying is that for silver bullet stock, right? Well, first of all, this is the security market line, which is the result of capital asset pricing model. And according to CAPM model, all stocks should lie on this line, depending on what the beta is. The risk-free asset has 0 beta. It's a 0 risk asset, right? So it has 0 beta, and it provides 5% return. So that's 1 point on the line. The market portfolio has a beta of 1, and it had a 12% return. So that was the other point, given 2 points, we can draw up a straight line, right? Which is described by the intercept of 5% and the slope of 12 minus 5 divided by 1, right? So the slope is just 12 minus 5. So rise over run, 12 minus 5 divided by 1, right? But that was the part of the equation. And silver bullet stock, it has a beta of 4. So according to CAPM model, it should provide a 33% return. But the return from silver bullet stock is only 30%. So it actually falls below the SML, right? It's not at the security market line. And that's an indication that we have an overpriced asset. Of course, you can take an overpriced asset and short sell it to benefit from it, right? But if you're plotting something on the security market line and it falls below, then it's an overvalued asset. And if it falls above, it's an undervalued asset, right? So just remember that. All right. Mr. What the Heck is well schooled in capital asset pricing model and the resulting security market line. He wonders if expected rates of inflation in the future were to rise, would it impact the SML and the required return on various assets? If so, how? Then recently, Mr. What the Heck has also become aware that market risk premiums change over time. For instance, during recessions, market risk premiums increase, right? People become more risk averse and they want higher return to take any risk. So he wonders how this may impact returns on various assets. Can you help him figure all this out? Well, let's look at a security market line, or the original SML, right? And of course, it's a linear relationship between beta and returns of various assets. Now, if inflation were to increase, that this is the nominal risk-free rate, right? And what's the nominal risk-free rate? It's the real risk-free rate plus inflation premium. So if inflation were to increase, then we will see that the nominal risk-free rate will rise. And because of that, all assets will see an increase in their returns, no matter what the beta is. It's basically a parallel shift in the security market line, right? Now, the second scenario, inflation did not go up, but we entered into a recessionary period and people's preference for risk declined. They became more risk averse. They want to play it safe. And so the market risk premium goes up, right? So what's the market risk premium? Well, it's the return of the market minus the risk-free rate, right? If risk premium goes up, then we have a new market return, right? And because of this increase in market risk premium, we have a new SML. And what happened now? Well, there's not a parallel shift, but it rotated, right? And we can see that now also all assets, their returns will rise, but assets with higher risk premium will have to offer much higher return, right? So the increase is not the same for all assets. Safer assets will see much lesser increase in returns. More risky assets will see a much higher increase in returns. All right, now let's talk about the notion of market efficiency, right? And that is basically how fast does information get priced into stock. So we, when we're looking at stock and a bond, well, we're looking at the cash flows in the future, right? Which is based on information, the safety of the cash flows based on information, the level of cash flows based on information we have today, right? So how is the company going to do? What would be the dividend payments, etc. All of that. So IM, a crook, is a trader who swears to possessing secret high-tech trading techniques, which help him pick out winning NYSE stocks, right? Simply by examining trends in the historical price and volume data. Right? NYSE stands for New York Stock Exchange. I, may be honest, is another trader who claims to be able to consistently pick winners from less developed equity markets, but only after a thorough examination of company fundamentals, industry characteristics, and economic outlook. Who do you believe and why? And of course, we got to talk about market efficiency. Frame your answer in context of efficient market hypothesis. So, what is market efficiency all about? We have 3 levels of market efficiency, right? So once again, the notion of market efficiency says that it has to do with how quickly does new information get priced into the markets. In other words, if I were to find out that Exxon has found new oil reserves worth $100 billion, right, then it's a company that's worth $100 billion more. And if there are 100, if there are 100 billion shares outstanding for Exxon, then each share's value should go up by $1, right? And that's means that is pricing of information. But how quickly does that happen? It has much to do with the notion of market efficiency. So the lowest form of market efficiency is weak form efficiency. And it says that you can't really use any information from the past to come up with the new value of the stock tomorrow. So when you're looking at, say, charts and graphs of historical stock prices and volumes, right, and you try to use those to predict the future path of stock prices, well, it wouldn't work in weak form efficient market because all that past information is already priced in, right? It's only new information that's relevant to the stock's price will change the price of the stock. So if you're looking at this historical data and you're able to come up with a winning strategy time after time, then that market is not efficient, right? Because obviously it's not incorporated all relevant information into the price of the stock yet, right? But any level of efficiency, even the weakest form, will render the reading of charts and making inferences from it about the future will render that useless. That's called technical analysis, and technical analysis will not be of any use, right? And we still see a lot of people engaging in that and in the markets, but trying to determine patterns from graphs and charts of historical data and believing that pattern would repeat itself, right? Or trying to convince others. But that's technical analysis, and even in weak form efficient markets, that historical information will not be of any use because all relevant historical information is already priced in. The second form of efficiency is called semi-strong form efficiency, right? And now we're not just talking about historical information, but we're also talking about all information that we have about the company's future in today's environment. So we can scan all news articles like Exxon hitting new oil well, right? That's new information. But as soon as people find out about it, they all come to the same conclusion that the price should be $1 higher, and sellers will increase their selling price by $1. Buyers will increase their buying, the willingness to buy. They'll be willing to buy for $1 higher. Of course, everybody is looking for a bargain, but in semi-strong form efficient markets, that's going to happen pretty quickly, almost instantaneously. So if we look at the current prices, then they are reflective of all material public information, which includes fundamental information like the company's balance sheet, income statements, etc., the ROE, ROIs, also all news, which is relevant to the company's future prospect. All of that gets priced in, right? As long as the public knows it. So we're talking about material public information. So what this is leaving out so far is non-public information, like private information. So if you are the CEO of a company, you know more about the inside of the company, you know more about what your company is going to be doing before the public does. And if you trade on that information, then even in semi-strong form efficient market, you will be able to make some abnormal gains, abnormal profits. So abnormal meaning over and above normal returns. Stocks do provide some positive return, right? We're talking about abnormal returns. And that's why we actually see that we have laws against insider trading, right? Those are insider trading laws because it's not fair. And if company insiders were able to use or allowed to use their inside knowledge and benefit from it in the stock markets, other investors would not be interested in buying the company's stocks, and the market will dwindle. So insider trading laws are there to protect the outside investors and make them be more willing to participate, thereby providing more capital to companies. Okay, so if we get to a point where even private information is not private anymore, as soon as information is created, it becomes public and gets incorporated into stock prices, then we have strong form information, right? When we're all information, there's no distinction between public and private information. All information is priced in. But that is, of course, an ideal that some people hope for, but we are not going to see, because companies are competing with other companies, and as such, they want to have some edge, right? There's always going to be private information available. So we'll probably never reach the strong form efficiency standard. However, we do reach in many developed nations, and especially in places like New York Stock Exchange, we will see that we've reached the level of semi-strong form efficiency, right? So what does that imply? Well, our question said Mr. I.M. Akruk is saying that he's got some secret technique and he can use that to buy NYSE stocks and that are winners all the time. Well, if that, we should not believe this guy. Mr. I.M. Akruk is not being honest. NYSE is a well-established, developed world equity market. For most part, New York Stock Exchange will be semi-strong form efficient market. And the techniques that Mr. Akruk espouses will not work even in weak form efficient markets, right? Because what he's talking about is basically technical analysis, and technical analysis does not work if markets are efficient at all, even weak form efficient. NYSE will have to be an inefficient market, an informationally inefficient market for its techniques or technical analysis to work, right? And it's important to remember here that we are talking about informational efficiency, right? There's other kinds of efficiencies too, like, for instance, economic economically efficient market is a market where you uh, it wouldn't cost you anything to trade. In other words, brokerage fees drop down to zero, then we would have economically efficient markets. All right, but we are talking about informational efficiency. On the other hand, Mr. I may be honest claims are more believable, right? Because it's talking about an less developed equity market. It's likely that the less developed equity market is not semi-strong form efficient, although they are very likely to be weak form efficient. But what he's saying, Mr. Maybe Honest claims to be successful with fundamental analysis, because he's saying with a careful analysis of a company's fundamentals, which is all of its financials, etc., and the prospect for the company and the economy. So you do careful analysis of the economy, the industry, the company itself, look at all the information that is out there which is relevant, and then use it to make predictions. Then you could pick winners, right? So Mr. Maybe Honest claims to be successful with fundamental analysis, right? Which would not work if the market was semi-strong form efficient. But in this market, we would expect it to be less than semi-strong form efficient market, right? And then fundamental analysis can work. So we can give Mr. Maybe Honest, we can give his claims some credence. Right? He's probably telling the truth. And that's the end of this session. Well, I hope that made you learn